In the financial landscape of 2025, the roar of the bull market is deafening. The S&P 500, the tech-heavy Nasdaq, even the small-cap Russell 2000, all have shattered their previous records, climbing to dizzying new heights. At the heart of this relentless ascent is a single, transformative force: artificial intelligence. Tech giants like Nvidia and Alphabet have swelled into multi-trillion-dollar behemoths, and the investor excitement has become so intense that one prominent investment firm described the market as .com on steroids. It's a powerful phrase that evokes a vivid and, for many, a painful memory. The last time a new technology promised to reshape the world so completely, it ended in a historic crash that wiped out trillions of dollars and shattered the dreams of a generation of investors. This brings us to the most critical question on Wall Street today. Are we witnessing a repeat of history? Is the AI boom of the 2020s simply the dot-com bubble of the 1990s in a new, more intelligent disguise? Or is this time truly different? To find the answer, we must look beyond the stock tickers and dive deep into the one thing that never changes: human psychology. To understand if we're in a bubble, we first need to define it. A market bubble is a period of rapid, unsustainable price increases, where the value of an asset, whether it's a stock, a house, or a tulip bulb in 17th century Holland, detaches from its fundamental, intrinsic worth. The price isn't driven by rational valuation anymore. It's driven by belief, by narrative, and by emotion. The most powerful of these emotions is FOMO, the fear of missing out. It's a deeply human instinct. We see our friends, our colleagues, our neighbors getting rich from a stock that seems to only go up. The rational part of our brain might whisper warnings about risk, but the emotional part screams that we are being left behind. As one analyst from the firm GMO noted, the fear of missing out does seem to be what is going on. It's the assumption that everyone else is getting rich, and we can too, if we just jump in before it's too late. But FOMO is only part of the equation. A bubble truly inflates through a more complex psychological phenomenon known as common knowledge. This is an idea from game theory, explored by thinkers like the Harvard psychologist Steven Pinker. Common knowledge isn't just when everyone in a group knows something. It's when everyone knows that everyone else knows it, and everyone knows that everyone knows that everyone knows it, and so on, infinitely. Think about the difference between sending a secret email to 10 people individually versus sending one email with all 10 people copied in. In the second case, the information becomes common knowledge. It creates a shared reality, a basis for coordinated action. Financial markets, and especially bubbles, thrive on this. The value of a speculative asset often depends less on its actual utility and more on the collective belief in its future value. As Pinker's work suggests, economic bubbles are driven by this very force. The 2022 Super Bowl was a perfect example. Crypto companies spent millions on 30-second ads that didn't explain what blockchain was. They didn't need to. Their goal was to create common knowledge. The message wasn't, "Crypto is valuable." The message was, "Look at this ad." Millions of your fellow Americans are also looking at this ad. We all now know that we all know about crypto. This creates a common expectation that other people are investing, so you should too. Today, AI is the new subject of that common knowledge. The constant media coverage, the breathless headlines, the viral success of AI tools, it all reinforces the idea that AI is the future and everyone knows it. This shared belief system is the fuel that allows a market fire to grow into an inferno. The psychology is timeless. The question is whether the fundamentals can support the flames. For anyone who lived through the late 1990s, the current environment feels eerily familiar. Back then, the transformative technology was the internet. It was going to change everything: how we shop, how we communicate, how we work. And it did. But the market's expectation of that change ran far ahead of reality. The dot-com narrative was intoxicating. It was a new economy, a new paradigm. where old metrics like profits and revenue didn't matter. All that mattered was growth, capturing eyeballs, and having a com at the end of your company's name. Investors poured money into companies with flimsy business plans and no clear path to profitability. Companies like Pets, Com, which spent millions on Super Bowl ads to sell pet supplies online, became market darlings before spectacularly collapsing. Webvan promised to revolutionize grocery delivery, raised hundreds of millions of dollars, and went bankrupt. The Nasdaq index quintupled in value between 1995 and its peak in March 2000, only to lose nearly 80% of its value over the next 2 years. Now, let's draw the parallels to today. First, the narrative. Replace the internet with artificial intelligence. The belief is the same. This technology will fundamentally reshape every industry on the planet. And just like in the 90s, this is probably true. But the hype cycle is creating a sense of unlimited, immediate potential. Second, the skyrocketing valuations. In the 90s, any company related to the internet saw its stock price soar. Today, any company perceived as an AI play is being rewarded with a massive valuation premium. The fervor around Nvidia, whose chips are the backbone of the AI revolution, is the modern equivalent of the excitement that once surrounded Cisco systems, which made the plumbing of the internet. Both are essential infrastructure providers for a technological revolution. Cisco's stock soared more than 100,000% in the 1990s, becoming one of the most valuable companies in the world before crashing along with the rest of the market. Third, the public mania. In the late 90s, taxi drivers gave stock tips. Today, AI tools and their implications are discussed everywhere from corporate boardrooms to family dinner tables. The technology is accessible, it feels futuristic, and it's easy to get caught up in the excitement. The psychological conditions are, in many ways, a perfect mirror of the past. The stage is set with the same props and the same script. But are the actors different? This is where the argument becomes more nuanced. While the investor psychology may be a direct echo of the past, the underlying fundamentals of the companies leading the charge are, in many cases, profoundly different. The first and most crucial difference is profit. The dot-com bubble was defined by what was called burn rate, how quickly a company was spending its investors' cash with little to no revenue coming in. Profitability was a distant, often theoretical goal. Today's AI leaders are not just profitable, they are gushing cash. Nvidia isn't a speculative startup. In the last fiscal year, it generated over $60 billion in revenue and nearly $30 billion in net income. These are not imaginary eyeballs. This is real money, from real customers buying real products. This isn't Pets, Com. This is a company with a dominant market position selling the most valuable commodity of the 21st century, computational power. The same holds true for other leaders in the space. Microsoft, Google, Amazon, these are not fledgling companies built on hope. They are established multi-trillion-dollar behemoths with diverse, highly profitable business models. They are integrating AI into existing ecosystems of software, cloud services, and advertising that already generate hundreds of billions of dollars a year. This leads to the second key difference: the players and the infrastructure. The dot-com bubble was characterized by an army of startups attempting to disrupt old industries from the outside. The AI revolution is largely being driven from within, by the largest and most powerful corporations in the world. They have the capital, the talent, and the existing customer base to deploy AI at a massive scale. This provides a level of stability and strategic execution that was absent in the chaotic free-for-all of the late 90s. The revolution is being led by generals, not just by rebels. The third difference is the breadth of the market's strength. While AI stocks have been the undisputed leaders, the 2025 rally has been remarkably broad. The record highs weren't just for the Nasdaq. The S&P 500, representing a wide swath of the American economy, also reached new peaks. Even the Russell 2000, an index of smaller companies, joined the party. This suggests that investors aren't just betting on a narrow technological theme. They're expressing a wider confidence in the economy as a whole. It indicates a healthier, more distributed optimism than the tunnel vision focus on tech that defined the dot-com era. So, we are left with a fascinating paradox. The market's emotional temperature, the public narrative, the fear of missing out. It all feels like 1999. But the financial statements, the corporate balance sheets, the profit margins, they feel like something else entirely. Something more solid, more real. So, is this .com too? 0. The answer is not a simple yes or no. If we look through the lens of human psychology, the parallels are undeniable. The siren song of a transformative technology, the intoxicating fear of being left behind, and the powerful force of common knowledge are creating a feedback loop of excitement and speculation that is a carbon copy of past bubbles. Human nature, in this regard, has not been upgraded. However, if we look through the lens of a financial analyst, the picture changes. The companies at the center of the AI revolution are not the speculative, profitless startups of the dot-com era. They are established, cash-rich monopolies and oligopolies with fortress-like balance sheets and proven business models. They are selling real products to real customers and making staggering amounts of real money. Perhaps the best way to describe our current moment is not as a bubble, but as a period of extreme, hype-fueled valuation layered on top of a genuine and powerful technological shift. The hype may be a bubble, but the shift is real. The danger lies in the market's inability to distinguish between the two. As one observer noted, the market seems to be making a one-way bet on AI mania, while appearing to ignore alarming fundamental issues. It is, as they say, priced for perfection. And in a world of geopolitical risk, economic uncertainty, and the ever-present threat of a simple change in narrative, perfection is a fragile state. Ultimately, we are witnessing a grand battle between timeless human emotion and modern corporate fundamentals. And history has shown that in the short term, emotion often wins. But in the long run, fundamentals are what anchor value to reality. The question that remains for every investor is which timeline they are operating on. What do you think? Are you seeing a once-in-a-generation buying opportunity, the dawn of a new age? Or are you hearing the faint, distant pop of a bubble about to burst?